In this video, guys, let's check out floor trader pivots. Stay tuned. Hey traders, a very warm welcome to you. Thank you for joining me. All right, so floor trader pivots are, well, they say, I guess they come from the floor traders who used to very easily and simply define ranges. Now listen, these aren't revolutionary, very, very simple maths behind them. But ultimately what we're trying to do here, as with all indicators and with all these kind of things, is to frame the trade in a specific way. So these are for intraday traders, specifically more geared towards people who are trading the indices like SPY, if you're using an ETF or the S&P 500, Dow, NASDAQ, that kind of thing. And what they do is they have a pivot point, they have an S1, which is called support 1, R1, resistance 1, S2, R2, R3, etc. and they go all the way out. Now, the theory is that the market is going to touch the next day's pivot very, very frequently. It's going to touch S1 or R1 multiple times. And when it gets to extended levels like S2 and R2 or even S3 and R3, the market might run out of steam. Now, there's some issues with using it, which we'll look at in a second. But I think if you're trading intraday and you're trying to find a way to frame your trades better, to find good places for targets as well, these aren't a bad place to start. Let's hit the screens and have a look. All right, guys, so I've got S&P 500 up here. From the indicators wise, it's just pivots. If you type in pivots, if you don't miss the P, if you type in pivots, it's the standard pivots there. And when they come in as the default with all these ticked, S3, S4, etc. You don't need those. The idea is, I mean, listen, if it starts to really motor and you need them on, then just go and click them on. But it's just cluster you don't need. The chance of market getting to those frequently is low. So you pivot, you support 1, your resistance 1, you support 2, resistance 2. Now, the way they're calculated is they're calculated based on the prior day's trade. So when you sometimes get a large gap, they become a little bit less meaningful. So, I mean, bearing in mind, I'm doing, in fact, you know, if we scroll back a little bit, because that's the Christmas period, there's a lot of mess going on there. If we go to like some normal conditions, if you like. So just to kind of reiterate that point, when you have a large gap, then they are less useful, if not useless, because the market's repriced. And the idea is use these when you have, you know, normal trade like these kind of 4 days in a row. So these pivots here are based on this trade here. So you got your pivot point here, you got your S1, your R1, your R2, etc. Now the theory is that the market very often will stay within S1 and S2, and when it's a quiet market, it will stay between R1 and S1. And very often, as you see, it will ping pong back and forth amongst kind of different levels. So if we skip to this day here, this third day, R1 was a very decent resistance, came back, tagged the pivot, held on the pivot, came back and only just managed to break out a little bit and then close below R1. Same with this day here, support 2 held after the opening drive, went back right up to the pivot, held at the pivot again, a little bit of breakthrough, came down, and then really we never got back through to support 2 again. And not too much interest going on here, quite a quiet day. Market kind of stuck in between R2 and S2 and couldn't really break out until the end of the day. And even at the end of the day, it couldn't close below S2. So you start to see here, and this one, which was a large day, obviously this, when we start to break out here, and this is when we can start put on more different levels. So we can put on R3, we can put on 4, we can put on 5 if we want. And you can see how that does contain price quite a lot. Now this is obviously a really big day, big opening drive, came to R3, pause, ripped straight through to R5. An unusual day, but one that's still interesting to frame, because you can say, okay, well, if I'm doing normal technical analysis, I'm saying, all right, it's breaking out of the high and it's ripping. Right, well, I'm not going to be too keen to start fading stuff, but if I'm long, why don't I use these as a good place to initiate a target or initiate a scale? So I know that many traders, we struggle sometimes to run trades, especially if we've got extensions, where's it going to go? This is not a bad place to start. Put your pivots on, stick on whatever pivots you need and say, right, well, we're well above this. We could easily run on to the next level on the resistance or the next support if I'm looking short. So let's reduce those back off again. Just it's a kind of a nice thing to help frame your trade. And if you start to see how often markets will hit these levels. So here, R1 held it almost to the tick, came back, pivot held again, and we closed kind of at the midpoint. The next day, gap up, R2 held. The next day, very shallow range. This is good actually for when you're in range bound conditions, because very often it will stick, the price will stick between kind of R1 and the pivot or S1 and the pivot, and just rattle around there for a bit, not doing too much. Now, bearing in mind, as you know, if you have a very quiet day, then the next day's range between R2 and S2 is going to be very narrow. So they do have the limitations, of course, as with everything, but I think they're a very useful kind of tool to use. If we look at the Qs as well, very similar kind of pattern on the Qs. They're handy, they're traditionally used when you have an opening and a closing. So the 24 hours, they're not as good, although you can still use them on Forex, just slightly different ways of using them. But the point is, guys, is that it's a very good place to not necessarily just pull the trigger blindly, but it's a good place to go, hey, you know what, we've come down quite a bit. If we flush at the open, I'm going to look to maybe initiate at S1 if I get a trigger on the candlestick. So maybe these two pin bars at S1 was enough for you. And then, again, we're just kind of plucking stuff out of the air here. You might say, right, well, where am I going to look for this to go? If it's the best trade and if I kind of hold the last one, where am I going to run to? Well, I can frame it and say the pivot's not out of the question. Yesterday's pivot was here, so that wouldn't be out of the question. And many times you might be closing it early thinking it's run back, and there's nothing wrong with that. But if you're looking for extensions, then it's not a bad place to look and say, okay, how about the pivot? And again, you might not want to pull the trigger directly. You might want to say, okay, let's see if we get reversal at the pivot. Well, that big bar there might be enough to get you out, or this kind of double top here. There must be some sort of news that came out there, but this kind of double top and fake out here above the pivot was enough to get you in. Or you say, okay, it's gone quite long enough, I'm going to look for R1, didn't get it, and come out of the pivot. So the point is it's a very easy and simple way of framing your trades with regard to zones to get interested in, if maybe you haven't got any key support resistance levels there. Or also, what I think is the most powerful part of them is to be able to run trades, because you can look back and go, hey, well, you know, 80% of the time we're hitting the pivot point, we're finding support here at S1 and we're bouncing. Why don't I leverage on that and look to hold that at least until we get to that pivot, and maybe I can look to scale. I'm not expecting it to kind of rip up to R3, but I've got frameworks, I've got levels. If I've not got any distinct key high or low, which is obviously going to trump everything. If you've got a high from yesterday or high from whatever everyone knows, and that trumps everything. But this is maybe an extra layer to help frame, segment, and just structure your trades a little bit differently. Take care, whatever you're doing, guys. Bye-bye.